April the 2nd is, you must admit, Arjun, potentially a big inflection point, because if it is reciprocal tariffs on friend and foe alike, then this trade war potentially takes on an entirely different hue, doesn't it? It becomes truly global, and that undermines the thesis of overweight South Korea, China and Taiwan.
Yeah, no, without a doubt. If things can go awry, I'm not going to deny that, where it could be a tit for tat type of situation where where tariffs escalate. But we think in all of these cases there are ameliorating circumstances. We like, for instance, Korea is our biggest overweight in the portfolio, and you'll remember Korea does have a free trade agreement with the U.S. So while Korea is very dependent on its exports and is a very globally exposed economy, we hope that free trade agreement, does its job and it saves Korea from the brunt of Trump's tariff threats. It remains to be seen. The tariff announcements coming on April 2nd, but we think in the case of Korea there's this issue. Now, on the flip side, you have China, which Trump has repeatedly talked about as being the focus of his ire. The good news is that the 60% number that he was talking about a few months ago now has scaled back considerably. We're talking now about 20%. Maybe there's a little bit more involved. But the important thing for China is that while exports are an important part of its economy, as a fraction of its economy, it's still relatively small. If you look at, for instance, the market cap of companies that are exporting to the U.S. as a fraction of the Chinese market cap, it's sort of in the 5% range, much lower than some of the externally exposed economies like Korea. So China, along with other policy levers like fiscal stimulus, like currency devaluation, should be able to navigate this tariff problem or this tariff issue. So Korea and China are our two biggest overweights in the portfolio.
So ultimately, do we need to build some downside protection into portfolios? And if so, Arjun, how would we express that? And do we join this flight to safety and flight to quality?
Well, typically, when things are really bad, you pay up a lot for that kind of insurance. We saw the VIX today hit about 28, certainly much higher than it is in the normal situation. Of course, we've seen during crisis periods, VIX go up to 50, 60. So, if you were to buy some downside protection in the form of puts, for instance, you could do that. You could obviously go get out of equities, go into treasuries. And we saw a little bit of that happening today. But then you could also do what we would consider to be also a very smart thing, which is to go into equity asset classes that are undervalued or that have underperformed the last few years. And emerging markets certainly fits the bill, namely China within emerging markets, but also Korea. On the flip side, you can go over to Europe, buy the European stocks, and we've seen that. And not surprisingly, all three of those regions have outperformed, despite the fact that especially Korea and China are very export-oriented economies. So one would think, in the face of tariff threats, those would be underperformers. But with a valuation tailwind, they've done well.